comments from Fed Chair Jerome Powell following the Federal Open Market Committee decision to raise the target range for the federal funds rate by 25 basis points, or 0.25% to 1/4 to 0.5%. That's the new range, and anticipates ongoing increases in the target range will be appropriate. Brad Smith here alongside Rochelle Akufo as well as Dave Briggs. And the decision today was widely expected to be a 25 basis point rate hike. That's just what we got. But interesting to hear Fed Chair Jerome Powell comment on a few things, and most notably here, a few things, including the median real GDP growth projections that they're looking for 2022, 2023, and 24 of 2.8%, 2.2%, and 2% respectively. That's compared to the prior projections that we had seen that were higher than that. We also heard Fed Chair Jerome Powell talk about the probability of a recession within the next year is not particularly elevated, but believes that the economy is very strong and able to withstand tighter monetary policy. And then just lastly, I'll add here that the expectation from the FOMC is that inflation will still begin to come down during the second half of this year, remaining high through the middle of the year, and then come down sharply through next year as well. So we'll continue to see how the markets digest this. We've been tracking the major averages and the tick by tick since Fed Chair Jerome Powell has been speaking this afternoon.
And to that point, we did see when the 25 basis point announcement came out, a dip in the markets, but then a rebound as we got more color from Fed Chair Powell. Well, let's also get some more color from our market panel who we'll bring in now. That's Tom Graff, Brown Advisory's head of fixed income, and Jeremy Schwartz, WisdomTree's global chief investment officer. So, Tom, I want to first start with you. Between the announcement and some of the color we then got from Fed Chair Powell, what do you think were the biggest takeaways, and what were you hoping to hear more detail on?
Well, thanks for having me. I think the biggest takeaway is that the Fed is feeling like there's a lot more room to hike, especially more room than the market thinks. And I also think that the Fed is ready to move pretty quickly on quantitative tightening. So hearing the detail that there's a plan, it's pretty well formed, and it sounds like it's probably going to be implemented as soon as May, were two pretty big takeaways for me.
Jeremy, we all expected the rate increase. Anything that the Chair Powell said that it surprised you, though?
I wouldn't say it was a surprise today. I think the thing that we're focused on is how wrong the Fed was on inflation before. And the question is, as they look ahead, how do they see inflation developing? You saw the number from that SEP projections, the dot plot that they put out in December. They're only projecting a 0.9 median Fed funds rate. That went up four hikes to 1.9 to 2% by the end of the year. No one thought anywhere close to 2% coming this year. And where they see inflation coming down to in 2023 is still well below actually where we see inflation coming in. So the question is the longer term Fed's hiking cycle projected as fast as it needs to be going into 2023 and beyond? I think that's going to become one of the key issues. Is inflation going to moderate as much as they're projecting? They've been wrong so far. I'm not confident that they're still at the high enough on where inflation is in 2023.
I want to stick with you for a second, Tom, on that comment of how wrong the Fed had got it previously. And we had heard something that I hadn't heard before. Our guest in the last hour gave us a comment on it, was inflation inferno. How much of today's announcements, the commentary even from Fed Chair Jerome Powell, was about reinstilling trust among the broader American public, who knows that the Fed is setting this rate policy to try and curb inflation at this point in time, and is looking for that inflation to come down, as we've continued to watch even the CPI data that came out?
For certain, it is a very high priority for the Fed is to reestablish that trust. The Fed's credibility is one of the most important tools they have in fighting long-term inflation and keeping those expectations in check. So I think that's why Powell probably, while he didn't necessarily want to hike 50 basis points, went ahead and projected that balance sheet tightening. I also think you note that he didn't kind of downplay the dot plot. A lot of times he would say, well, don't look too closely at that dot plot. This time he sort of embraced it. He said, look, there's 7 meetings, 7 hikes in the dot plot. You can do the math, sort of. And I think that was all meant to deliver this message of we're taking this inflation very seriously and we're going to do what we got to do to bring it down.
And Jeremy, I want to bring you in here because he did say that in terms of the framework, he said this will look familiar to the last time, but will be faster and sooner in the cycle than last time. For investors who are watching this, obviously seeing all this yo-yoing, what should they be focusing on at this point as they do brace for these 7 more rate hikes in the year?
Well, and they're talking about the balance sheet runoff where they added $5 trillion to the balance sheet, and are they going to, how quickly are they going to lower that balance sheet? I mean, one of the things you've seen, the 10-year has started to rise a little bit, but generally there was a flatter curve. The question will be, do they use some of that runoff to get the 10-year and get a steeper curve? A lot of people worry about if they invert the curve, is that going to cause us to get into recession? And we do think they will ultimately invert the curve. We're not as worried about that, but they raised $5 trillion of the balance sheet from $4 trillion to $9 trillion. They were only talking like $100 billion a month before, so maybe that becomes more. Maybe they do $150 to $200 billion a month, but it doesn't seem like that they're going to go that aggressive. But we'll have to see how fast they do let that balance sheet run off.
Tom, several reporters took a crack at asking the Fed chair how this will slow demand, and I don't know that anyone got a satisfactory answer there. Do you think increasing the rates will slow demand, and do you agree that he said we are not particularly elevated risk of a recession? Do we need a recession to slow demand?
Well, I don't know that we need a recession, but there's no way to slow inflation without slowing nominal demand. Like, in other words, you can't. The reason why inflation is so high is because consumers have both the income and the willingness to spend to bid up prices. It's not ultimately more complicated than that. So if you don't slow demand, you're not going to get any change in inflation. And I think he wants to dance around it because it's not a good look for a Fed chair to say we wish growth were slower, but that's kind of the fact. And I think it belies a little bit when he was talking about their own projection for GDP. I know that the war is definitely meaningful there, but I do think part of it is they think they need to put the brakes on much faster than what they thought a few months ago, as Jeremy mentioned.
As an add-on to that, he had said that we want financial conditions to tighten further from where they are now. As we tighten policy or become less accommodative, so too will financial conditions. What will that look and feel like for businesses, for the average American that's out there as well, that is also trying to navigate through the decisions that the Fed is still set to make? And I'll get your take on that very quickly once again, Tom.
Yeah, I don't know that it's going to affect Main Street as much as it's going to affect financial markets, because a lot of valuations have been tied to there being very low rates. And even today, the bond market still, as Jerry mentioned, how flat the curve is, that's still indicating that they don't think interest rates are going to rise that much. So I think that for financial markets, there's a skew to, if the Fed needs to get a lot more aggressive, that risk is skewed to the upside. As far as Main Street goes, look, I think there'd be some benefits to maybe the housing market not being as hot, where we've all heard the crazy stories about the bidding in that market. It might be beneficial if wage growth continued to be on an upward trend, but if there was a little bit more stability in the labor market as well. So I think maybe a cooling off wouldn't be the worst thing for Main Street, but it probably will have a pretty notable effect in financial markets.
Tom Graff, Brown Advisory Head of Fixed Income, as well as Jeremy Schwartz, who is the WisdomTree Global Chief Investment Officer, joining us here today. Thank you so much for the time and insights following the FOMC decision, as well as commentary from Fed Chair Jerome Powell.